Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Brian Stutland. He's the Chief Investment Officer, Equity Armor Investments, and we are going to take a look at the impact Apple has to the market, specifically the Nasdaq 100, and of course, trading these markets as we expect more volatility to come in September. And Brian, it's interesting, this week has heavily been focused on Apple because of the amount of press it got with its launches that were announced just yesterday. But we're also discussing about the impact it has to the market overall with the significant weighting that it has in the Nasdaq 100, and not just that index, but the S&P and others as well.
Yeah, certainly. I mean, Apple's up to what, over 10% weighting in the Nasdaq 100, and it's been a market leader. There's a reason why the weight has transferred to the upside, because when you look at Apple, down 13% or so year to date, is outperforming the Nasdaq. It has done all year. We almost actually saw it on the recent bear market rally that we had in July. We almost saw it get back to all-time highs again. So, and then obviously August was not so great for the stock, but certainly Apple, it's not as if they're innovating anything that entirely new. From, I would say, the 14 version to the X, relatively similar kind of functionality, maybe some upgrades on software. But what they've done is they've controlled such a big marketplace. They have such a big cash reserve that these bear markets are probably actually pretty good for Apple. It's almost become a value play. We've added it to our large cap value portfolio, as well as the Nasdaq 100. So, this is something that you can look at here that seems to be a leader. They actually like it when the market goes down because they can look for either companies to acquire with their huge cash balance sheet. They can get companies on the cheap. They can buy back stock. They can do lots of things to sort of boost their stock price to the upside, and they've done that all year long.
Right, but Brian, what does it mean to the market overall? As goes Apple, as goes the market. I mean, what about the fundamentals with all the other associated companies that make up thousands of stocks that trade?
Well, it's really interesting because Apple has been so highly correlated to the Nasdaq 100 or even the S&P 500, some of these other indexes that you mentioned. And so it does tend to be a leader. And it seems like you said, if Apple goes, the rest of the market tends to go and even get more volatile than what Apple is doing, which is rather interesting because a company of this size and magnitude now has really just cemented itself as the leadership of the market. It's something to watch. It's something to add to portfolios.
And Brian, let's talk about September and October trade, historically two of the most volatile months of the trading calendar. You expect more chop as we get into the fourth quarter. And you also mentioned to me that this is when you need to start thinking about picking your spots and rebalancing more frequently.
Well, you do. I mean, the Fed has done nothing to obviously inject liquidity. They're trying to withdraw liquidity, and that has raised volatility in the marketplace. With the VIX in the 20s, vol Q up even higher than that. So we've seen continual back and forth action. We get a sell-off like we did in August here. Certainly, it feels like it hit some sort of level, a little bit lower, around 12,000 in the Nasdaq, where it found some support and has rallied since. So I'm just looking to be somewhat of a trader to some degree and have a section of my portfolio allocated to just trading the market. And as we get these big volatile moves, which I think are going to continue for the back half of the year, it's going to give some traders some opportunity to get in and out and pick some spots. Whether you're looking at some of the technicals, you're watching the 10-year interest rate. Obviously, that's been a big component of the market. As rates have gone down, the market's been able to rally. As those rates have trended higher, or Powell has talked down the market with higher interest rates, obviously the market has sold off. So you just watch some of those words, and I've just been trying to be somewhat nimble and rebalance back and forth as the market moves.
Outside of technicals, when you're talking about picking your spots, are there certain sectors that you're leaning towards more than others?
Well, certainly we got underweight energy. It had such a big run up in the first half of the year, and right about June or so, we started lowering our exposure to that. A lot of similarities actually to 2008, when commodity markets really ramped up at the beginning of 2008 and then totally collapsed in the back half of the year. We sort of expected that to happen as well. And so I think that value portion of the portfolio that was geared towards energy, commodities, and utilities, I think we've looked at that as a way to underweight, look for other areas to allocate, more like consumer staples, being conservative in this market conditions. That's something that's somewhat interesting to me, rather than going energy or growth necessarily until we see rates start to plummet again.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.